Welcome to Chapter 1 of Managerial Economics. In this course, you will discover how economic thinking empowers managers to make smarter, data-driven decisions in today's complex business world. Let's begin our journey by understanding what you will achieve in this module. By the end of this session, you will master 5 critical learning objectives: defining managerial economics, distinguishing it from traditional economics, understanding its importance, exploring its scope, and applying key economic principles to real-world business decisions. Managerial economics is the application of economic theories and quantitative methods to solve business problems. Unlike traditional economics, which focuses on broad market forces, managerial economics zeroes in on practical decisions faced by managers, such as pricing, production, and resource allocation. For example, when a manager chooses between investing in new technology or expanding the sales team, they are applying opportunity cost and marginal analysis, 2 fundamental principles you will learn in this course. These tools help managers weigh benefits, costs, and risks to make optimal choices. Throughout this module, you'll see how managerial economics bridges theory and practice. You'll gain practical skills to analyze demand, set prices, forecast trends, and manage resources, preparing you to make confident strategic decisions as a future manager. Managerial economics is the discipline that applies economic theories, principles, models, and quantitative techniques to solve real business problems. It serves as a bridge between abstract economic theory and practical business decision-making, helping managers make rational choices under constraints. According to Spencer and Siegelman, managerial economics is the integration of economic theory with business practice for the purpose of facilitating decision-making and forward planning. Mansfield defines it as the use of economic modes of thought to analyze business situations. Joel Dean highlights that managerial economics shows how economic analysis can be used in formulating business policies. D.C. Haig describes it as a link between economic theory and decision sciences, providing tools for rational decision-making. In essence, managerial economics equips managers to make rational decisions by evaluating alternatives, considering opportunity costs, and optimizing resource allocation. For example, choosing between investing in new technology or expanding the sales team requires weighing costs, benefits, and constraints. In daily life, you apply these principles unconsciously. Choosing a bus over a cab reflects opportunity cost. Deciding to work overtime involves marginal thinking, comparing extra effort to extra reward. In business, these concepts guide pricing, demand forecasting, production, investment, and risk management. For managers, managerial economics answers critical questions. Should we launch a new product? What pricing model is optimal? How do we respond to rising costs? Should we expand, outsource, or innovate? It empowers leaders to navigate uncertainty and make data-driven decisions in dynamic markets. Managerial economics is fundamentally microeconomic in nature. It focuses on individual firms, industries, and markets, rather than the economy as a whole. For example, when a coffee shop considers introducing a premium coffee variant, it is applying microeconomic reasoning to improve its offerings and profitability. The discipline is pragmatic and applied, emphasizing real-world solutions over abstract theory. For instance, a logistics company analyzing the most fuel-efficient delivery routes is using managerial economics to solve practical business problems and reduce costs. Managerial economics is also normative and prescriptive. It does not just describe what is, but recommends what should be done to achieve business goals. For example, an HR manager designing incentive plans to boost employee productivity is applying prescriptive economic principles to guide organizational behavior. It is highly interdisciplinary, integrating concepts from statistics, finance, accounting, psychology, and operations research. A brand manager who uses consumer behavior data and price elasticity to set optimal prices is leveraging this cross-disciplinary approach. Every concept in managerial economics is decision-oriented. Whether it is a routine operational choice or a high-stakes strategic move, the goal is to provide managers with an intellectual toolkit to minimize errors and maximize outcomes. For example, A management team choosing between expanding production or outsourcing is guided by economic analysis. Managerial economics is forward-looking and proactive. Unlike classical economics, which often focuses on equilibrium, managerial economics prepares businesses for future demand, investment planning, and anticipating market changes. Predictive analytics dashboards help managers forecast trends and make informed decisions. Finally, managerial economics is flexible and adaptive. It evolves with changes in technology, market structure, and consumer preferences. Managers must continuously update their strategies to stay competitive in a dynamic business environment. Managerial economics is both a science and an art. As a science, it applies logical reasoning, quantitative models, and empirical analysis to business problems. As an art, it demands creativity, intuition, and sound judgment to navigate complex, uncertain environments. At its core, managerial economics is decision-oriented and goal-driven, empowering managers to make choices that align with organizational objectives. The field is dynamic, constantly evolving with advances in technology, shifts in market structure, and changes in consumer behavior. For example, the rise of digital platforms and AI has made data-driven decision-making and dynamic pricing essential for modern businesses. Companies like Amazon and SaaS providers use real-time analytics to adapt strategies instantly. The scope of managerial economics is broad. It includes demand analysis and forecasting, as seen in Netflix's use of predictive analytics to select new shows. It covers cost and production analysis, like Tesla optimizing manufacturing with IoT data. Pricing strategies leverage game theory and behavioral economics, as Amazon adjusts prices in real time. Profit management, capital budgeting, and risk analysis are vital for financial sustainability and growth. Managerial economics also addresses behavioral economics, sustainability, and global trends. FMCG and fintech companies use consumer psychology to design products and marketing. Firms invest in green technologies and ethical practices to meet sustainability goals and regulatory standards. Globalization and digitalization require managers to anticipate international risks and opportunities. The importance of managerial economics lies in its ability to transform intuition into intelligence. It enables data-driven decisions, strategic planning, innovation, and competitive intelligence. By applying these principles, managers enhance financial sustainability, demonstrate effective leadership, and respond proactively to market changes. In today's fast-paced world, managerial economics is essential for turning complexity into clarity and achieving long-term success. In summary, managerial economics equips leaders with the analytical tools and creative mindset needed to solve real-world business challenges, drive innovation, and sustain competitive advantage in a globalized economy. Managerial economics is deeply rooted in microeconomic theory, focusing on the behavior of individual firms and consumers. For example, an e-commerce company uses price elasticity to set competitive prices during festive sales, maximizing revenue by analyzing how customers respond to price changes. At the same time, cost optimization, such as reducing shipping expenses or negotiating supplier contracts, relies on microeconomic principles to improve profitability. However, managerial economics also draws from macroeconomics, which examines the broader economic environment. Factors like inflation, interest rates, and GDP growth directly impact business decisions. For instance, rising inflation increases raw material costs, while changes in interest rates affect borrowing and investment plans. Companies monitor economic news and forecasts to anticipate these shifts and adjust their strategies accordingly. In practice, firms must integrate both micro and macro perspectives. For example, a real estate developer may accelerate or delay projects based on central bank policy announcements, inflation trends in construction materials, and forecasts of urban growth linked to GDP. This convergence of micro and macro analysis enables businesses to make informed, resilient decisions in a dynamic environment. Modern managerial economics recognizes that optimal business decisions require understanding both internal microeconomic variables, like pricing, costs, and consumer demand, and external macroeconomic forces shaping the broader market. By combining these insights, Managers can navigate uncertainty, seize opportunities, and sustain long-term growth. In summary, managerial economics bridges the gap between micro-level operational decisions and macro-level economic trends, empowering firms to thrive in a complex, interconnected world. The managerial economist is a vital bridge between economic theory and business practice. In today's organizations, they analyze complex data, interpret market trends, and translate economic insights into actionable business strategies. Whether working with advanced business intelligence software or presenting findings to senior executives, their expertise shapes critical decisions across all levels of management. Traditionally, managerial economists forecast economic trends using econometric models, conduct cost-benefit analyses, develop pricing strategies, and evaluate market structures. For example, they might predict demand shifts for a new product or assess the financial impact of a policy change, ensuring the company's resources are allocated efficiently. In the modern business landscape, their role has expanded. Managerial economists now interpret digital data using artificial intelligence, conduct behavioral analysis, model risk scenarios, and advise on sustainability and ESG compliance. They help organizations navigate uncertainty, adapt to technological change, and pursue long-term value creation. To excel, managerial economists need a blend of analytical thinking, economic literacy, quantitative skills in statistics and econometrics, strategic communication, and broad business acumen. Animated overlays can highlight these competencies as they work, solving problems, advising teams, and supporting executive decisions. Ultimately, managerial economists act as advisors, risk assessors, and strategy architects. By converting complexity into clarity, they empower organizations to make informed choices, gain competitive advantage, and achieve sustainable growth in a rapidly changing world. The first fundamental principle is opportunity cost. Opportunity cost is the value of the next best alternative that is forgone when a decision is made. For managers, this means every resource allocation, whether time, money, or manpower, comes at the expense of another potential use. For example, if a company uses its capital to upgrade machinery instead of launching a new product, the opportunity cost is the profit that could have been earned from the new product. Recognizing opportunity cost helps managers make choices that maximize value. The marginal principle is about comparing the additional benefit of an action to its additional cost. In business, this means expanding production or investment only if the marginal benefit exceeds the marginal cost. For instance, if producing one more smartphone costs 10,000 rupees but brings in 14,000 rupees in revenue, the company should increase output. This principle ensures resources are used efficiently, maximizing profit at every step. The equi-marginal principle guides managers to allocate resources so that the last unit spent on each activity yields the same marginal utility. For example, a marketing manager should distribute the advertising budget across channels, like social media, TV, and print, until the return per rupee is equalized. This approach ensures the company gets the highest total return from its resources. The time perspective principle reminds managers to consider both short-term and long-term effects of their decisions. For example, offering steep discounts may boost immediate sales, but could harm the brand's value over time. Wise managers balance quick wins with sustainable growth, evaluating how today's choices impact future outcomes. The discounting principle recognizes that money has a time value. 1 rupee today is worth more than 1 rupee in the future. The present value formula is present value equals future value divided by 1 plus the discount rate, raised to the number of periods. For example, if an investment promises 1 lakh rupees in a year at a 10% discount rate, its present value is 90,909 rupees. Managers should invest only if the present value exceeds the cost. As we conclude Chapter 1, let's revisit the essential concepts of managerial economics. We explored its definition, characteristics, and the vital role it plays in bridging economic theory with practical business decisions. Managerial economics empowers managers to make informed, data-driven choices in complex environments. We discussed how managerial economics draws from micro and macroeconomics, adapting theories like opportunity cost, marginal analysis, and game theory to real-world business challenges. These principles guide pricing, production, investment, and risk management decisions. Remember the fundamental principles: opportunity cost, marginal and equimarginal analysis, time perspective, and discounting. Each principle helps managers allocate resources efficiently and make strategic decisions that drive organizational success. Reflect for a moment. How would you apply these concepts in your own career? What business decisions can you improve by considering opportunity cost or using marginal analysis? How might you use data to forecast demand or optimize pricing? As you advance in your management journey, use managerial economics as your analytical toolkit. Let it help you transform complexity into clarity and turn strategic choices into competitive advantages. Keep questioning, exploring, and applying these principles to real-world challenges. Thank you for completing Chapter 1 of Managerial Economics with IICT Business School. We hope you feel empowered to make confident, data-driven decisions in your future career. Remember, learning is a lifelong journey. Continue to apply these concepts and strive for excellence in all your endeavors.